Thank you very much. Thank you, Ryan, Nuri, and Andrew, for inviting me to present in this online seminar. I'm very excited about it, and I would like to thank everybody that has logged in. At least here in Europe, it's around dinner time, so that's nice that you have decided to log in. Now, what I will present is titled Debt Dynamics and Credit Risk. It is joint work with Stephen Schaefer from London Business School. He is supposed to be here among the audience. Now, what we're doing in this paper is we are trying to improve on the existing structural models. And why do we care about structural models of credit risk? These are kind of a benchmark workhorse in financial economics. And they've been used to examine a range of different phenomena like bond premiums, equity premium, rollover risk, liquidity risk, default predictions, jump risk premium, and so forth. So there's a lot of phenomenon that they've been used for, and what is important in these models is that these kind of merchant type structural models have kind of they have firm dynamics, and then the firm defaults the first time a firm value crosses a default boundary. Okay? Now, what we're doing in this paper is rather than the extant literature that has kind of examined structural models and their ability to price is we will look at structural models from a slightly different perspective than the existing literature that has kind of investigated risk premium assumptions and asset dynamics. What we're going to do here is we are going to look at debt dynamics and the importance of debt dynamics for structural models and how they price and how you can extract different, say, premium from these models. And maybe surprisingly, there has been very little work on investigating these debt dynamics, how they look in the data, how we can incorporate those in the models. And that's the goal today. And what we're going to find is that we're going to examine some new facts about how firms they use that, how much they use, and in which situations. And then we're going to incorporate some stylized facts into a model, and we're going to see that it actually improves pricing significantly, particularly for short-term maturity debt. Okay. Now, it's kind of surprising maybe that there's been so little research on actually trying to specify the debt dynamics in these structural models. First of all, because the focus has been on asset dynamics, the jumps, is a stochastic volatility, so forth, and also on different kinds of risk premium. Okay, while basically there has been very little indirect evidence. I mean, there's been a little examining what different debt dynamics assumptions like stationary leverage does to pricing, but there's been no direct evidence. And by direct evidence, we mean that let's look at the data. Let's see how firms use debt. And let's try to incorporate that in the model. Okay, so we're the first one to document kind of direct evidence for debt and how to use that in a structural model. And in a sense, it's surprising because in contrast to risk premium and asset values, debt levels are directly observed. And as we're going to show, it's also going to be very important, the debt levels, because that specifies the default boundary. It's going to be very important for spread predictions and also default predictions. And just to kind of delineate from the corporate finance literature, I mean, there is a lot of empirical evidence on the dynamics of leverage in the literature. But there's been very little research directly on the dynamics of debt. And that's a goal today, because that is what's important for structural models in terms of specifying this default boundary. And then we're going to ask, well, how can we use this debt dynamics, these stylized facts that we're going to find, and use that for corporate bond pricing? Let me just give one example that that illustrates a main feature or a main fact that we're going to find, and that we are going to find to be important for pricing in structural models. This example is Chaparral Energy. It's a gas and oil exploration company based in Oklahoma, and doing a little bit also in Texas. But this company has struggled the last few years as commodity prices has decreased. And this picture shows the equity price of Chaparral Energy. And as we see, the stock price has decreased strongly, meaning that there's been a negative shock to the firm. And although it's not clearly visible, the firm has particularly struggled in the spring as the COVID crisis hit, and commodity prices went further down, and eventually they filed for bankruptcy last month. Okay. Now, what is going to be important is we look at the amount of debt that that firms have, and in Chaparral Energy's case, what we see here is that during the period where Chaparral has struggled, they've taken on more debt. Okay, we see that before the mid 2018, debt was increasing. At that time, they had a credit facility, and they draw on that credit facility. Then in June 2018, they issued a bond of $300 million. And then for a while, they didn't take on additional debt. But then last year, they started to take on more debt. They drew on a new credit facility. And as we see throughout 2020, they have drawn heavily on the credit facility until they eventually defaulted. The important thing here is, say, as we price this bond in say July 2018 at issuance, what we argue here is it's important to take into account that if this firm starts to struggle, it will take on more debt. Okay, and that's a phenomenon that we're going to find in the data, and a phenomenon that we're going to then include in a structural model. Okay, because a standard model, say a stationary leverage model, would predict that as the firm starts to struggle, the firm decreases debt because it wants to maintain a stationary leverage. Okay? And just to provide a simple simulation illustration of why this matters, I have this graph of a simulated firm value. That's a fundamental item in these merchant type structural models. On the x-axis, we have future horizon in years, and on the y-axis, we have firm value in billions here. I mean, the precise numbers don't matter, but here the firm starts by being worth 2 billion, and then off it goes. And here the firm starts to decrease in firm value and so forth. Now, here's the standard assumption on the default boundary. Okay, here the nominal debt value is around 0.7 billion at the time zero, and the standard assumption is that the debt level remains constant, i.e. the default boundary remains constant. There's a long history of literature and also some recent papers quoted here that use this assumption, and in that case, what we would see is that the firm would default after 11 years, okay? As firm value goes below the default boundary, okay? And by the way, this is a slight extension of, and typical in the literature, rather than the classic Merton 1974 model where the firm only could default at maturity. Here the assumption is the firm can default at any time before, okay? Now, here's another assumption. Again, the same simulated firm value. Let's assume that we have a Black-Cox 1976 model, namely that the firm deterministically increases the amount of debt, okay? This might be reasonable because after all, empirically, as we'll also see, we do see that debt increases over time. Otherwise, leverage ratios would go to zero at some point. Now, if that's the case, as we see at a debt level increase, firm will default after 3 years, okay? On the other hand, we could also have that debt ratios are stationary, leverage ratios are stationary. That's kind of the Cullen, Dufresne, and Goldstein 2001 model. And in this case, I mean, as the firm starts to struggle, the firm decreases the amount of debt, okay, at some speed of adjustment. Now, in this case, as we see, the firm never defaults, or at least it doesn't default within the first 20 years, okay? So this is just to illustrate that the default boundary, which is specified through the level of debt, is actually very important for a structural model. And that's the goal of this paper, to explore the empirical dynamics of debt and incorporating those, okay? And what we are going to find is, first of all, not surprisingly, we're going to find a significant growth in the average level of debt, okay? We are going to document a negative relation between leverage and debt growth, meaning that firms that have low leverage, they take on more debt in terms of percentage than firms that have high leverage. And then the most interesting finding is that we will look at firms and condition on their future equity returns, okay? So we're gonna look at firms that have positive and negative shocks to, in a sense, fundamental value. And what we will document is that those firms that have a negative shock to fundamental value, they will, during the shock, take on more debt than those firms that are not shocked. But after the shock, they're gonna take on less debt and end up with a lower amount of debt than those who are not shocked, okay? So there are important differences between short-term dynamics, what happens during a shock, and long-term dynamics, what happens after the shock, okay? Then we're gonna incorporate these debt dynamics into a merchant-type model, and we're gonna look at the pricing of this model, okay? And what we're gonna find is that our proposed model substantially improves the pricing of short maturity bonds, okay? And in particular, investment grade bonds, okay? Now, that's important for pricing it itself, being able to price better corporate bonds. It's a huge market, but it's also important because there's a largely recent literature that focuses on short-term spreads, argues that these are kind of the spreads where you can best extract different risk premia, like liquidity risk premia and jump risk premia, and find significant premia here. How we contribute there is that, well, we're finding actually, once you account for the dynamics of debt, a standard model can explain more of these short-term spreads than previously believed, okay? So what we're saying is that, well, the jump risk premia and liquidity risk premia found in that literature at least is overstated, because some of the premia that they find are actually kind of standard compensation for a default risk. Okay? And I think now is a good time for questions.
All right, Peter. So here I have one question. Since you're looking at the level of debt rather than leverage, do you think choice of denominator in the definition of leverage makes significant changes in those models?
In the denominator, and by that, I guess, okay, so I guess there's a question of, there's a question actually in the literature, at least if that's what the question asked about, is, well, how do we define leverage? And particularly there's a question of, do we use market values or debt book values for debt? And I think there, I think it matters for the most risky bonds. For the most safe bonds where you have kind of debt values are close to par, it doesn't really matter. So I think in this case, what we are finding here, how we define leverage is kind of standard by quasi-leverage using market value of equity, book value of debt. But using market value of debt wouldn't change our results in any significant way.
Okay, debt is heterogeneous, maturity type, etc. Does it matter for you, especially when you value short-term debt?
So yes, debt is heterogeneous, and when we value short-term debt, I think it's an interesting question, and there is a literature. I mean, I think kind of actually explicitly take into account the debt structure, meaning what different kinds of short and long maturity debt there would be is an interesting avenue, and there is a couple of papers going that route. I think here we're kind of taking a step back and simply looking at the notional amount of debt, not distinguishing between in any significant way between short-term debt and long-term debt in terms of pricing. I think it kind of could matter how much short-term debt and how much long-term debt. We're not distinguishing here, but it's kind of, I think it would be interesting to look at that in kind of future research, but we haven't done that.
Okay, let's move on, and I'm sure the questions will keep coming.
Mm-hmm. Okay, so let me first show some results on debt dynamics. So what we do here is we take data from CRISP Campustat. We are using a period of 52 years. We have more than 17,000 firms and 185,000 firm years. And we then have the total amount of debt, the nominal amount of debt, which we define as debt and current liabilities plus long-term debt, okay? That's the standard definition of debt used in Welsh and a range of other papers. We also have some results where we show it doesn't really matter whether we net out cash or not. So our results are robust to that. Then we're using, again, also the standard definition of leverage, or quasi-leverage, if you will, which is the nominal amount of debt divided by the nominal amount of debt plus the market value of equity. Okay? Now, here's the first finding, which is very unsurprising. Meaning on the x-axis, we have future horizon in years, and on the y-axis, we have the log growth in debt, okay? And the black line, along with confidence bands, simply shows that on average, debt growth is significant over time, okay? So we kind of see that on average, debt grows more or less by 10% per year in this time period, okay? I mean, this is not surprising, but nevertheless, I do want to kind of note this because by far the most common assumption in this literature is that debt, future debt is constant over time, okay? So there's zero growth in debt. Now, this is
just one clarification question, I'm sorry.
Yeah.
Does survivorship bias explains that the debt increases over time? Do you think this could be one of the factors affecting it?
Of course, I mean, survivorship bias is an issue here, and that's an issue that is, of course, not unique to our paper, but kind of the whole literature on leverage dynamics. I think what makes me less concerned about survivorship bias is that the results that we're going to document, and also the debt growth I'm going to show in a moment, the results are very robust and persistent across different leverage ratios, even those firms with the lowest leverage ratio. So seeing that the patterns that we're going to find is also present in those firms that are safest makes me less concerned about survivorship bias.
Another question here was, has that ratio also increased over time?
Sorry, has?
Debt ratio, I'm not sure what that could mean. I will clarify that question later.
Okay, okay. Now, here's the same graph, but conditioned on an initial leverage ratio. Okay, so here we look at the thinnest line. That's those firms with a leverage ratio below 20% at time zero, and the next line is kind of between 20 and 40% and so forth. Okay. Now, what we see here is that there's a clear difference between firms that have a low leverage ratio and high leverage ratio in terms of how much their debt grows. We see those that with the lowest leverage ratio has substantial increases in debt by roughly 20% per year, while those with the highest leverage ratios actually see a decrease in debt, okay? At least for the first few years, okay? then eventually you see that those firms start taking on more debt. But it's very clear that the debt growth rates are very different across different leverage ratios, okay? Which is consistent with a standard stationary leverage model, by which you would have, if these firms have a common target leverage ratio, you would think that those with a low leverage ratio, they take on more debt to increase their debt and meet the target leverage ratio, while those with the most debt, they try to reduce their debt, okay? Now, the final finding I'm going to show is how debt dynamics depend on future events, and particularly how it's path dependent. Okay, so what we do here is we condition on future firm shocks. Okay, and by firm shocks we're simply proxying future equity returns. Okay. So in this case, we're using 3-year equity returns. And particularly the way we do it is that for a given cohort of firms in a given year, if we don't condition on leverage, we just have all the firms in year T, we calculate all their equity returns, 3-year equity returns going forward. And then we sort those firms into 2 groups. Those firms that have a higher equity return than the median, and those that have a lower equity return than the median. Okay, and those that have a higher equity return, we denote high shock firm, and those that have below the median, we denote the low shock firm. Okay, or negative shock firms. Okay, and then we look. For those cohorts, we then determine how is the level of debt, how is the level of debt evolution for the high shock firm and the low shock firms in years in the future, both during the shock and after the shock. Okay, and we do that for different cohorts, and then we take the average across all the cohorts. Okay, so a firm may be a high shock firm in 1 year, and it may be a low shock firm in another year. Okay, depending on the equity returns around that time. Now this is what we find, and what we do here in the figures is that we condition on initial leverage. Okay, so if we focus on the top left graph, what we see here is we have simply taken a whole sample of firms during those 52 years, and then we have restricted our attention to firms with a leverage ratio of 20% or below, and then for each year we have sorted those firms into high and low equity return firms, and done that for all the years, and then taken the average debt evolution. Okay, and what we see here on the top left-hand corner is that for those firms, we see that among those firms that had low equity returns, during the first 3 years on which we condition on the equity return, the low equity return firms, they take on more debt. Okay, then the high equity return firms, okay, because the black line is above the green line. Then we also see that after the equity shock, that reverses. So they start on taking less debt than the low equity returns firms take on less debt than high equity return firms. And eventually, after 6 years, the low equity return firms have less debt than the high equity return firms, okay? So in the long run, it appears that the low equity return firms, they take on less debt, which would be consistent with the leverage ratios being stationary. But in the short run, the reverse happens in the sense that the low equity return firms, they take on more debt, which is kind of the opposite of what you would expect from a stationary leverage model. And we see that this pattern is not dependent on what initial leverage ratio these firms have. Of course, the average growth rates of high and low firms is, but not the pattern of high versus low growth firms. We see that for example, the top right-hand corner, those firms with a leverage ratio between 20 and 40%, we see the same pattern. And in fact, we see the same pattern for all leverage ratios, okay? And just one note regarding what is going on here. What we can see here, if we look at this slide, is that, I mean, one explanation could be that these firms, they take on more debt because they're hoarding cash. And in fact, then net debt, that is debt minus cash, it doesn't show this pattern. But these graphs shows, here I haven't conditioned on leverage ratio, but I could have. It wouldn't change the results. What we see here, actually, that this pattern is persistent both on the top right-hand corner for short-term debt, top left-hand corner short-term debt, top right-hand corner for long-term debt. And we also see that for cash, the low equity return firms, their growth rate in cash is less than the high equity return firms. Okay, so at least it's not the case that they hoard cash. And by the way, the conditioning on equity returns, now in the main results, we're using conditioning on 3-year equity returns, but really that horizon doesn't matter, okay? Meaning here, we are taking all firms across all different leverage ratios, and then we're conditioning on 1-year return, 3-year equity return, 5-year and 7-year. And regardless of what horizon we're conditioning on, we see the same pattern that low equity return firms, during the shock, they take on more debt, and then after the shock, they take on less debt, okay? So let me just kind of summarize what I've shown so far, namely that we do show that debt increases on average over time. We do see that there's a negative relation between debt growth and leverage. So low levered firms take on more debt. And then finally, we see this pattern that if a firm experiences a negative equity shock, that firm takes on more debt in the short run during the shock, and then less debt in the long run, relative to a firm that had a positive shock. Okay? Any questions?
Okay, here's a clarifying question. So, are future shocks to stock returns known at the time of debt changes? For example, do you use shocks to the expected stock returns? Or if you mean the unexpected component of stock returns, I'm not sure how to interpret changes in debt conditional on future information.
Yes, the way we interpret, I mean, we're just looking at equity returns. So it's not, it's just the realized equity return. So we're not trying to distinguish between expected equity return and an unexpected equity return. In a sense, we are regarding the future equity return as an unexpected shock.
Okay. Is it possible that those low equity return firms take more debt to initiate more buybacks or higher dividends to compensate equity holders for the low return?
Okay, is it, can you just repeat that question?
Is it possible that low equity return firms take more debt to initiate more buybacks or pay out more in terms of dividends to compensate equity holders for the low return?
Could that be? Potentially. I guess, I mean, I think I would have to think about that precise mechanism and whether that mechanism could explain both the debt growth in the short and the long run. So I would have to think more about that. Generally, I would say that we're not microfounding this this pattern. We're simply documenting, and then we're incorporating a structural model. But I think it's kind of interesting to explore further what the firms and why the firms are actually doing what they're doing. Okay, but that's not a goal in this paper. So kind of the short answer is I'm not sure.
Okay. The trade-off theory of capital structure is just one view of how firms make financing decisions, which is the main theory that gives rise to stationary leverage. But there are other capital structure theories that would predict different debt dynamics, pecking order, market timing, rating targets, and so on. So are you proposing a new capital structure theory?
Yes, I think that's a great question. No, we're not proposing a new theory. What we are simply proposing is we're finding some empirical dynamics, and then we are simply using those dynamics to incorporate in a structural model. And again, we're not trying to come up with a new theory to explain why the firms are doing that. I think it would be great to get a bit of understanding of it. And particularly theories that could explain both the short run and the long run dynamics of debt. But that's not what we're trying to come up with. We're simply documenting those and then incorporating those in structural models.
Okay, so here are a couple more questions related to interpretation of what we see here and some corporate finance implications. So would you say that your results so far, basically empirical regularities that you observe, are consistent with firms drawing down against the line of credit during bad times and then paying back in better times to retain a cushion against future shocks?
Yes, I think that's also a great question, and I think yes. That's probably one interpretation that seems reasonable. I mean, that's just almost like the example with Chaparral, that are using their credit facility to draw on that. So yes, we're not documenting that because we don't have that detailed debt information, but I think that's definitely a potential explanation.
Okay, how does the use of collateral change around the negative shock? And I assume this is not what you've been doing in this paper so far.
No. I mean, we're not looking at
what drives the changes, right?
Yeah, I mean, we're just looking at the changes. We're not looking at the collateral around the negative shock. I think again, I mean, going back to the example of this oil and gas firm, I think there is this kind of very interesting question that what happens to the collateral, and particularly actually in the Chaparral case, they had a credit facility that was reduced precisely because the bank valued the collateral lower. I think so. So I think that's a very interesting question, but it's not what we're doing in this paper. Again, we're not trying to explain and microfound exactly how they do it and how that interacts with the with collateral valuation, but clearly it's important, but not for what we're doing here in terms of pricing.
Okay, thank you.
Yeah. Okay, so next, what we're going to do is we're going to take these documented patterns and then we are going to incorporate it in otherwise standard structural model. So we're going to take kind of the most standard structural model off the shelf, which is nevertheless used a lot also in recent literature, which is namely kind of a merchant type model where we have the value of the firm's assets follow a geometric bound in motion. It has a drift under the risk neutral measure equal to the risk-free rate minus the total payout rate to debt and equity holders. And then there's under the historical measure, there's a higher drift because there's an asset risk premium. And again, we are also following the literature here and assuming that the Sharpe ratio that determines the asset risk premium is constant, okay? Empirically, we're going to assume it's 0.22, which is kind of the gold number in this literature. But this is completely standard, so there's nothing new going on here. What is new is we're going to look at different models for the debt dynamics, okay? Because now we specified the asset dynamics, we also specified the risk premium that changes the drift between P and Q. Now we're going to specify the amount of debt, okay? And we're going to look at 4 models. The first 2 models are due to Black-Cox, 1976. So in the standard model, which we call BC0G for zero growth, future debt is simply constant, okay? And small k here is just the log of debt, the total notional amount of debt, okay? So the BC0G, that's just assuming that debt is constant in the future, okay? That's, again, just slightly different from the very classic Merton model, which also assumes constant debt, but you can only default at maturity, while in this model, you can default at the first time that the firm value goes below the default boundary, okay? Then we're also going to look at a model with a growth rate in debt. So we'll call that BC, which is a black box, which just assumes that the log growth rate of debt is constant and equal to a gamma. Okay, which seems plausible given that we see that there are average increases in the amount of debt. Nevertheless, I'm not sure that I've seen this model kind of implemented and tested in the literature. So this model is not really used. Now, the third model we're going to look at is the stationary leverage model of Colin, Dufresne, and Goldstein. Right? So they assume that leverage ratios are stationary, meaning that there are changes in debt, locally deterministic changes in debt. Okay, there's a target leverage ratio, nu, and if the leverage ratio is higher than nu, then the firm decreases the amount of debt, and vice versa if it's lower. Okay? And the mean reversion, the speed of mean reversion, is equal to lambda. Okay? Now, the final model is a new model that we're going to propose, which is based on the Colin, Dufresne, and Goldstein stationary leverage model, but with an additional component, okay? Namely that debt is stochastic. Okay? There's a mean reversion component, just as in Colin, Dufresne, and Goldstein, which is locally deterministic, but then there's also shocks to the amount of debt, modeled through another Brownian motion. Okay, and importantly, we allow for correlation between shocks to debt values and shocks to firm values. Okay, and this correlation might be positive or negative. We will estimate this correlation. Okay, with these models, what we're going to do is we're going to try to fit the parameters of these models to the empirical dynamics that I've already been going through, okay? And just to note that these models, they have very few parameters, meaning the BC zero growth model has 0 parameters. The BC model has 1 parameter, the growth rate, while the stationary leverage model has 2 parameters, lambda and nu, the target leverage ratio and the speed of mean reversion, while our model has 4 parameters, okay? The lambda, nu, and the sigma, the volatility of shocks to debt, and the correlation between debt and equity values, okay? But even though there's 4 parameters, in reality, there's only 3 identified parameters because the volatility of debt and the correlation is not separately identified. It's only the product that's identified. So in effect, there are 3 parameters in this model. Okay? What we're then going to do is we're going to take those models, we're going to estimate the firm parameters, and then we're going to look at a representative firm by taking the average of firm values like asset values, average asset volatilities, and average growth rates in asset values and so forth. And then we're going to fit the parameters in the debt dynamics for the 4 different models to the average future debt, and then the average future debt for high versus low equity shock firms, okay? So we're going to take those moments for different horizons and for different leverage ratios, and then we're going to fit the parameters of the model such that they best fit these patterns, okay? And again, I just want to note that at max, in the stochastic debt model, there are 3 parameters. So all the models have between 0 and 3 parameters. So it's very few parameters to fit kind of a wide range across different horizons of debt dynamics that we observe in the data. Okay. Any questions on how we estimate these parameters?
Now that I see in the chat, I will bug you when I see some questions there, right?
Okay, great. Then I'll continue. Now, here's the fit of the 4 models for the average growth rates across different leverage ratios. So again, if we focus on the top right-hand corner, what we see, and what we see is the black line, which is the actual debt growth rate in the data across different future horizon years for firms that have a leverage ratio of 20% or less. Okay, this is actually just to go back just to be very clear, this is the graph I already showed here on slide 12. And here we're just fitting the different models to these 5 curves. And that is what these 5 graphs show. And what we see, not surprisingly, in the top right-hand corner is that the green line, that's a black Cox with 0 growth model that cannot capture any growth rate in debt. And therefore, it's far from the black line. Okay? The blue dotted line is a black Cox with constant growth. That can't capture it either. It predicts a much too low growth rate. Why? Well, because it's not just fitting the growth rate of the low leverage firms, it's fitting the growth rate of the different firms with different leverage ratios, okay? So that's why it kind of fits the average growth rate, and it underpredicts the growth rate of low leverage firms, and it overpredicts the growth rate of high leverage firms, okay? In contrast, we see that both the Collin-Dufresne and Goldstein stationary leverage model and our proposed stochastic debt model fits the average growth rate of debt well across different leverage ratios, okay? And again, I just want to emphasize that the Collin-Dufresne and Goldstein model has 2 parameters, while our model has 3 parameters. So it's not evident that these models should be able to provide a reasonable fit across different leverage ratios, but they do, okay? We also see that essentially it makes no difference whether we're looking at the Collin-Dufresne stationary leverage model or our stochastic debt model. There's no really difference in how these models, they fit average growth rates in debt across different leverage ratios. Now, what these graphs shows is, if we focus, for example, on the top left graph, it shows on the x-axis again future horizon in years. On the y-axis, it shows the difference in growth rates. Okay, and it shows the difference in growth rates between high return firms and low return firms. Okay, so what the black line shows is we have for the top left corner firms with a leverage ratio below 20%. We look at those whole sample, and again we're then doing this for each cohort, conditional on 3-year equity returns, looking at the low return firms and high return firms. And then instead of looking at separately the growth rates of those two, we take the difference in the growth rates across different horizons. So for example, when the black line has at a future horizon of 3 years, it says minus 0.15. That data point simply means that the low return firms, they take on 15% more debt after 3 years than the high return firms. Okay. Now, what we see from the graphs, and for example, again, focus on the top left corner, is that first, both the black Cox, whether it has growth rate or not, doesn't capture this pattern, because it just, there's no difference between high and low return firms, because the debt growth is either 0 or just deterministic, constant. Okay, so there's no difference between high and low return equity return firms. In contrast, we see that the stationary leverage model of predicts that there's a positive difference between high and low return firms. Okay, in contrast to what we see in the data. Okay, which is because if you have a negative shock in that model, you try to reduce your debt, versus if you have a positive shock, you try to take on more debt to keep leverage ratios stationary. Okay? We also see that the stochastic debt model captures this pattern quite well across different leverage ratios, meaning that the stochastic debt model does actually capture that these low return firms, they take on more debt in the short run and then less debt after the shock in the long run. Okay? Now that's captured through the correlation parameter, okay? Because empirically, what we find is that this correlation is negative between changes in debt and changes in firm value. Okay, so that's why you can have kind of a low shock firms that taking more debt than high shock firms, because of this negative contemporaneous correlation between asset value and debt values. But in the long run, there's a positive difference because it has a stationary leverage component to it as well. Okay, and again, we see that by and large, it captures the phenomenon in the data for all different initial leverage ratios.
Peter, guess it's unsurprising that your model is going to perform better than models with fewer parameters, right? So if you have a model with more parameters than with fewer parameters, the model with more parameters is going to fit better. So would it be a fair comparison or fair basically criticism of earlier models that they are not really fitting this new dimension? And what would be, you think, the benchmark, a better benchmark for you to compare your results to in terms of, you know, how many degrees of flexibility they have?
I think that's a great question. I would say, first of all, I mean, there is one parameter more, and so the added complexity is extremely modest in that model relative to, say, a stationary leverage model. And then the second point I want to make, that what we're going to do in the pricing exercise is that we are going to use those parameters that we estimate for the debt dynamics, and then we're going to estimate the remaining parameters of the models, not using corporate bond prices, and then we're going to take those models and price corporate bonds. Okay, so we're going to estimate the parameters from, in a sense, what we see in the data, and then we're going to take it and pricing. So in a sense, you may say it's a completely out of sample pricing exercise that we're going to do, because we're not going to use the bond prices to actually estimate the parameters. So in that sense, it's not at all clear that this model would do better in terms of pricing, simply because we're not using the prices to estimate the parameters.
Okay.
Okay, great. Let me then go through how we take these models to the data. And for the pricing data, we have several sources with data. So just to kind of make clear that when we're looking at debt dynamics and we're estimating the debt parameters, we are using kind of 52 years of firm data from Chris Cumberstad. When we do the pricing, we're using U.S. corporate bond pricing for the period 1988 to 2018. Okay. The first 6 years of the data sample, we have quotes from Lehman data. For the next 5 years, we have quotes from Merrill Lynch data set. And then for the last 16 years, we have transaction data from Trace. Okay? We're using only non-callable straight bonds, so there are no options involved. And we're using bond months observation. And at the end, after kind of seeding out odd bonds and callable bonds and so forth, and bonds where we have firm data available, we are left with around 120,000 bond months observations. Okay? What we do in that data is that for each bond month observation, we calculate firm volatility, we calculate payout rate, we calculate the leverage ratio, and we set the Sharpe ratio to 0.22, which again, all these calculations are completely standard, and we, in calculating these, we follow completely what we do in another paper we have in RFS in 2018. Okay, and also to fit these models, we fit them to the historical cross section of default rates. Okay, because we want to make sure that at least on average, that these models they are consistent with historical default rates. Okay, so what we follow is we follow what we did in our RFS paper, where we found that rather than fitting to single default rates, it's statistically much more precise to fit to a cross section of default rates. And particularly the way we do it is that we assume that the firm defaults not when firm value goes below the nominal amount of debt, but when the firm value goes below some fraction of the notional amount of debt. Okay, a fraction D. Okay? D is one parameter for each model, and then we're going to take these models and fit it to this big cross section, and then we're going to for each D find one model that on average fits the historical default rates across rating, across horizon from 1 to 20 years best. Okay, so each model will have one D. This is just to make sure that an average default rates are captured. we're going to estimate, we're going to throw 2 models more in there because we're going to find that firm-specific target leverage will be important. Okay, so for the 2 models, the stationary leverage model and our stochastic debt model, besides having the assumption that there's a common target leverage ratio, we will also assume that there's a firm-specific target leverage ratio. Okay, and we're going to do the most simple we could come up with in terms of how we define this target at our firm-specific target leverage ratio. We'll simply set it to the firm's historical average leverage ratio. Okay, I'm very well aware that one could come up with more better models for what the target leverage ratio of these firms are, and so one way to think about this is that the pricing improvements we're going to find for these stationary leverage model and the stochastic debt model is going to be a lower bound of kind of how well they can do in terms of pricing if you were to come up with a better model for the long run target leverage ratio. Okay, so in the end we have 6 models here where FL denotes firm specific leverage. Okay. Any questions?
Surprisingly not, but again, I will let you know. Thank you.
Okay, great. So here's first the estimation of the default boundary. Okay, we have the 6 different models, and remember this is a D that is the fraction of nominal amount of debt at which the firm defaults. Okay, and what we see here is, if we focus on the stochastic debt model, is that it has a lower default boundary than the other models. Okay, say the black Cox with 0 growth, or the stationary leverage model, which is kind of 0.85 to 0.89. Okay? While the stochastic debt model with firm-specific leverage has 0.63. And what is interesting is that we do actually have an empirical estimate of what that number should be. Okay, because there is Davydenko in his 2012 paper, he does actually estimate when do firms default. What is firm value relative to the notional amount of debt when they default? And the number that he finds is they default at 66%, okay? Which is pretty close to the stochastic debt model of 63%. While some of the, say, the benchmark model, Black Cox 0 growth, actually has a default boundary which is too high relative to the empirical estimate. Okay, so that's kind of a first, at least nice observation, that the stochastic debt model seems to be empirically more plausible, has a plausible default boundary than some of the other existing models in the literature. Now, the next thing we do is we calculate model spreads and we calculate actual credit spreads. So again, here we're completely standard. We assume that we're pricing a 0 coupon bond, and then we're calculating the credit spread within the model. And when we calculate the credit spread within the model, we assume a recovery rate, which is 33.5%, which is the historical recovery rate for senior unsecured bonds. And for the actual spread, we are taking the corporate bond yield relative to the swap rate, okay? Which again is kind of what is most commonly done in the literature. Now, this table shows what are the average spreads across investment grade and spec grade and across different maturities in the model, and in the different models and in the data. Okay, so for example, we see that if we focus on investment grade from 0 to 3 years, we see that the actual spread in our data sample is 77 basis points, and we also see that the models, they're a bit all over the place. Okay, but for example, the Black Cox 0 growth model can actually on average capture this 77 basis points almost by 72 basis points, okay? While the stochastic debt with firm-specific leverage has 54 basis points, is quite up there, but not quite, okay? We also see that the black Cox with the growth rate simply has the term structure wrong, okay? Too low spreads at short horizons, too high spreads at long horizons, because we see the short-term investment grade spreads of 24 basis points is too low, and for long-term 209 is too high relative to the actual spread of 131 basis points, okay? But we see the kind of the stationary leverage model without firm-specific leverage, CDG, and the black Cox with zero growth, and also the stochastic debt model with firm-specific leverage. They can also kind of on average capture the slope of the investment grade term structure, okay? But it's also clear one critique of these models recently has been said, well, it's kind of misleading to look at average spreads because some of these models, they capture average spreads by having counterfactual individual bond spreads, by having a few bonds with much too high spreads and then a lot of bonds with much too low spreads. Then the average is right, but kind of the individual bonds are just wrong, okay? So this table is kind of an interesting first step, but it's also clear that we need to dig deeper into the data, okay? Now, and just to illustrate that, here I'm taking the same data set, but I'm excluding 2008 and 2009 that had extremely high spreads, okay? And suddenly we see a somewhat different pattern. If we focus on investment grade spreads, 0 to 3 years for investment grade, the actual spread excluding those 2 years is 48 basis points. And now basically all of these models, they underpredict the spread, okay? And this stochastic debt model with firm-specific leverage kind of underestimates it the least with 32 basis points. While, for example, the black Cox with zero growth only has 17 basis points, okay? So we can kind of see what appears to happen is that, for example, the black Cox with zero growth kind of just has very high spreads during the crisis and then much too low spreads outside the crisis. Now, we're going to dig deeper into that. And the first thing we're going to do is we're going to look at the monthly average spreads. So for each separately investment grade and spec grade for different maturities, we're going to calculate a monthly average spread crossing those buckets. And then we're going to compare the time series of actual and model implied spreads, okay? And we're going to calculate some soda R squared that explains how well does the model spread explain the actual spread, okay?
Okay, Peter,
yeah.
Here's the question. So you take the average recovery rates of the entire sample, but there's evidence that recovery rates are procyclical. Can that improve your estimates?
Yes, I think so. It can improve, it can definitely improve the estimates. So I think that's one improvement of the model. I think it cannot change the relative rankings of the model. So, I mean, what we are documenting here is that it's important to take into the debt dynamics. And I think we can improve on that dimension. And I think having time variation in recovery rates, that may improve these models further, but it's not going to change the relative rankings of these models, okay? So we're going to document stochastic debt is important, and that conclusion would be robust to having time variation in recovery rates. Okay. So in this table, we show the R squared of how well does the monthly spreads in the models align with the actual spreads, okay? And I just want to focus on a couple of numbers here. There's a lot of numbers, and for longer maturities, there's not a huge difference between the models, and there's no consistent difference between the models. What is really striking here is that it's a stochastic debt model, particularly with firm-specific leverage, that has a better time series fit to these monthly average spreads, and it's particularly for short maturities, and not least for investment grade bonds, okay? So we can see the R squared is substantially higher for these short maturity bonds for the stochastic debt model relative to these other models, okay? The question is why? And these graphs illustrate why. These graphs simply shows the time series of actual and model implied monthly spreads for the different models, okay? And what we see is, for example, on the top left-hand corner, we see the black Cox with zero growth. That's kind of the benchmark model in the literature. And what we see is that most of the time, it underestimates, in normal times, it underestimates actual spread substantially. And by the way, on the right-hand side, I have log spread in basis points. But then it overpredicts spreads during the crisis. Okay? While if we look at the bottom right-hand corner, we see that the stochastic debt model with firm-specific leverage, for most of the time, it actually captures monthly average short-term investment grade spreads well. Okay? It seems to underpredict a bit during the crisis, and it certainly underpredicts between 2010 and 2014. So it's by no means a perfect model, but outside that period, it seems to do a quite good job of capturing actual spreads. Okay, and just, I mean, the reason we have taken logs on the y-axis is that if we look at levels, we basically just see a big blip during the crisis. It's very difficult to discern differences outside the crisis. Okay, but this also illustrates on the top right-hand corner. Why is it that the black cocks with zero growth can capture the average right? It's because it had huge predictions during the crisis, and then it underpredicts during the rest of the time. Okay, not so with the stochastic debt model. Now, what we further do is we look at individual bond pricing. Okay? And again, we are looking at what is the soda R squared? How well does these different models within different investment grade and spec grade and different maturities, how well do these models kind of price individual bonds? Okay? And I mean, the first answer is actually all of them do quite poorly. Okay, these soda R squared, they're not impressive. It's zero if the model doesn't predict better or worse than just predicting a zero spread. Okay, so I think, I mean, one point is that these models are just currently, I mean, they price individual bonds quite poorly. When you group them into kind of portfolios, they do much better, as we saw in the previous slide. Okay, so it may be that maybe these models are not that bad, but potentially there's a lot of noise in the specific model parameters that are estimated, like asset volatility. But nevertheless, another point I want to make, that if we look at the differences in fits, then the stochastic debt model with firm-specific leverage actually has kind of the best overall fit among the models, and particularly it does substantially better than the black cocks with zero growth. And particularly for short maturity bonds. So again, we see here that at least it has positive R squared, while the black cocks actually does a terrible job. It's much worse than just predicting a spread of 0 basis points. Okay. So again, we see that it's predominantly short-term spreads and particularly investment grade spreads where this stochastic debt model kind of improves on the predictions. Now, the question is, first of all, why is that the case? And here we just kind of further show that, well, the improvement in individual bond prediction comes from a more reasonable distribution of spreads. Okay, this shows a QQ plot, and it shows the QQ plot for just short-term investment grade credit spreads. Okay, so if the distribution of model implied spreads are completely aligned with the actual spreads, what we would see is we would see graphs that lie on top of a 45-degree line, which is the black line. Okay, and then the bottom, in the bottom graph, what we see is, for example, the blue line is the stochastic debt model with firm-specific leverage. We see that, yeah, the blue line is not perfectly on top of the black line, but it's not doing a bad job either. Okay, meaning that it seems like at least there's a decent alignment in the distribution of short-term investment grade spreads implied by the model and those in the data. Okay, but we also see that it's kind of too high at low predicted spreads, meaning that there are too many observations where the spreads in the data is basically is positive, while the spreads in the model are zero. Okay. But if we compare with the other models, for example, the top model, and here we can see the black cocks with a zero growth, the red line, we do see that generally across the board, that model predicts too low spreads. Okay, for spreads that are up to 600 basis points. Of course, I mean, I haven't shown here because that would kind of make it difficult to discern. At some point, the red line dips below the black line because it's gonna. I mean, the model is gonna predict very high spreads for these most risky firms, okay, or bonds. But the main point to take away is here that the stochastic debt model has a much more reasonable distribution of spreads, and not just average spreads, but distribution, than the other models, okay? Now, the final result I just want to show is, why is it the case that the stochastic debt model is better at predicting short-term spreads, okay? And to shed light on that, what we do is we take each model. So we take the stochastic debt model and we take also the other models, set firm value to 1, which doesn't matter, it's just a normalization. And then we simulate 3 million pairs of firm value, and we simulate 3 million pairs of nominal debt, okay? Then we record the time tau. If at some point during these simulations, for each simulation, if at some point during the next 20 years, firm value dips below the nominal amount of debt, we record, or the default boundary, we record firm value at default, okay? And here the default boundary depends on 2 things. I mean, it depends on the estimated D. So we're using the estimated D that we estimate in the empirical section, which is kind of the fraction of debt at which the firm defaults. And then we're of course using the simulated amount of debt K, okay? In the zero growth Black-Cox model, it's just constant. In other models, it may be stochastic, okay? And then for each horizon, we keep computing the average value of the firm at default, okay? So the last picture here I'm gonna show you is what are the results here? And we're taking 3 different firms. We're taking kind of an average investment grade firm. In the middle, on the left-hand side, we are having a safe investment grade firm, and on the right-hand side, we are having a risky investment grade firm, okay? So we can kind of think of this in the middle as the average, on the left-hand side as good times, firms, investment grade firms in good times. On the right-hand side, we can think of this as investment grade firms in crisis times, like the financial crisis 2008, okay? Now, if we focus on the middle graph, what we can see here is that, and on the x-axis, we have future horizon in years, okay? So 5 here would mean what is, if the firm defaults after 5 years, in this model, what's the average value of firm value in at 5 years, okay? And what we see if we look in the middle graph, for example, we see, and focus on the stochastic debt model, which is the black dotted line, what we see is that firm value, particularly at very short horizons, are much higher than in the other models, okay? What this means is that, the firm defaults simply earlier in the stochastic debt model. It can default quite quickly relative to the other models. The reason being that, well, if it defaults very soon, it's because that firm value really takes a series of negative shocks. And what this means is that because there's a negative correlation between firm value and debt value, then the debt value takes a series of positive shocks. So in a sense, there's kind of a double sandwich there, or debt spiral, as you may call it. Not only does firm value go down substantially, default boundary goes up substantially. And that's why that the firm defaults at a much higher firm value for short horizons here, okay? And the left-hand graph shows that that's particularly so for safe firms. So that shows that why this model is substantially better at pricing these short maturity investment grade bonds, okay? On the right hand, we see in contrast, actually the default boundary is lower in the stochastic debt model for very risky firms relative to the other models. So again, that explains why there's not these kind of extreme spreads in the stochastic debt model relative to some of the other models, okay? So let me just summarize. What we document in this paper, we have debt issuance, we document debt issuance behavior. On average, debt increases over time. Higher leveraged firms, they take on less future debt. And we show this pattern that if there's a negative equity shock to a firm, it takes on more debt during the shock, less debt in the after the shock, relative to a non-shock firm. Okay? Then we include those dynamics into a merchant type structural model. And in particular, I mean, we have target stationary leverage, and most importantly, and that's a new part, is we have stochastic debt, which is negative correlated with equity returns. We're showing that that is important for pricing of corporate debt, particularly short maturity bonds. Okay. Great.